Hello, and welcome to 10-Minute Mastery. This session will be about journalizing merchandising transactions. This is part 3, journalizing sales-related transactions for a merchandising business using the perpetual inventory system. By the end of this 10-minute mastery, you will be able to journalize sales-related business transactions occurring within a merchandise business. Let's review what we know about a merchandising business. A merchandising business will purchase products to sell to customers. In a perpetual inventory system, each purchase of merchandise is recorded in the inventory account along with each sale of merchandise. As a reminder, the definition of journalizing is the process of recording business transactions using a journal. Keep in mind, every transaction impacts at least 2 different accounts. In a perpetual inventory system, the inventory records are continuously updated. This also means they are perpetually updated. Let's work some examples. Transaction, October 1. Sold merchandise on account to Raleigh Company in the amount of $22,250. Terms, freight on board shipping point, net end of month. The cost of merchandise was $10,000. Remember that net end of month means the payment is due by the end of the month that the sale was made, and the freight on board shipping point means that the buyer pays the freight costs. This transaction will involve the following 4 accounts: accounts receivable, Raleigh Company, sales, cost of merchandise sold, and the merchandise inventory. This is what it looks like journalized. First, we enter the date, October 1. Our first debit here is to merchandise inventory in the amount of $22,250, and then we enter our credit, same amount, using the accounts payable Raleigh Company account. This involves 2 journal entries. For the second journal entry on the very next line, we enter the date 1. Our credit is to cost of merchandise sold in the amount of $2,000. And then using the merchandise inventory account, we also need, in the same amount, our credit, $10,000. Let's look at example 2. Transaction, October 2. Sold merchandise for $76,000 plus an 8% sales tax to retail cash customers. The cost of merchandise sold was $41,400. So using the 8% sales tax here, we're going to multiply 76,000 times the 8%, and we get our sales tax amount, and that's $6,080. So the cash amount here that we are dealing with is going to be the $76,000 plus the sales tax amount of $6,080. Let's see what this looks like journalized. Using these accounts, cash, sales, sales tax payable, cost of merchandise sold, and merchandise inventory, we'll journalize 2 journal entries here. First, we have the date, October 2. The first debit is going to be utilizing the cash account in the amount of $82,080. Sales is credited for $76,000. Sales tax payable is also credited for $6,080. The next journal entry, cost of merchandise sold, is first. That's our debit in the amount of $41,400. Merchandise inventory will get the credit of $41,400. Let's look at example 3, transaction, October 5. Sold merchandise on account to Peak Company in the amount of $37,300. The terms are freight on board destination, 110, net 30. Cost of merchandise sold is $20,000. So here we need to do the math. we're going to take into account that 1% discount. So there's a 1% discount if the buyer pays within 10 days. We're going to do that math. You can see that there at the bottom. We have $37,300 and we subtract the discount. The final amount there is $36,927. Let's see what this looks like journalized. Using the following 4 accounts: accounts receivable, peak company, sales, cost of merchandise sold, and merchandise inventory, we'll make 2 journal entries here. The date is October 5 for both entries. The first debit is going to be to accounts receivable, peak company, in the amount of $36,927. In the same amount, the debit is to the sales account. For the next journal entry, we have cost of merchandise sold, which was $20,000. Merchandise inventory is then credited for $20,000. Example 4, transaction. This one occurred on October 15th. Received check for amount due $36,927 from Peak Company for the sale that occurred on October 5th. For this example, we'll use the cash account and the accounts receivable Peak Company account. And this is what it looks like journalized. We use the date here of October 15. The debit is to cash in the amount of $36,927. And our credit is going to involve the accounts receivable Peak Company account in the amount of $36,927. Example 5, transaction. On October 31st, we received a check for amount due from Lolly Company from that October 1st sale, which was in the amount of $22,250. The accounts impacted are cash and accounts receivable, Lolly Company. This is what it looks like journalized. We use the date first, October 31. The debit is then listed first in the amount of $22,250 to the cash account, and the credit is in the same amount. We are going to use accounts receivable, Lolly Company, for the credit. Thank you for viewing. Feel free to leave a comment below and be sure to subscribe.